Good morning. This is Bloomberg Daybreak Europe. Happy Friday, everyone. I'm Tom McKenzie in London. These are the stories that set your agenda. Traders trim bets on a Fed cut next month after Jay Powell says there is no hurry to lower rates, with the US economy in, quote, remarkably good shape. President-elect Donald Trump picks vaccine-skeptic Robert F. Kennedy Jr. to lead the health department, but there is no room for JP Morgan CEO Jamie Dimon. Plus, Asian equities gain with signs that China's stimulus efforts are bearing fruit. Retail sales growing at the strongest pace in 8 months. Let's check in on these markets then. The Asian session broadly positive, a little bit of softness over in mainland China. But yes, the data, particularly when it comes to retail sales out of the second largest economy on the planet, of course, the retail sales data suggesting that maybe that economy is starting to bottom out. European futures, though, pointing to losses of 0.5% after the rally of more than 1% yesterday for European stocks. You are set at this point for a third straight week of losses for European equities. FTSE 100 futures currently down by 0.3%. Oil will be a drag there, with prices falling once again in the session today. S&P futures pointing lower by 23 points, down 0.4% after some modest losses yesterday. Nasdaq futures pointing down by 121 points. US stocks fell about 0.6% yesterday. Some of that tied to what we heard from Jay Powell at the Federal Reserve. Let's split the board and have a look cross-asset with a focus then on the US 2-year, where you did see yields up at one point about 8 basis points on the back of those comments seen by some, at least in the markets, as relatively hawkish from Jay Powell. Markets now pricing in just 2 additional cuts from this Fed by June of next year. 4.35 then on the 2-year. The pound in focus, we have GDP data out of the UK, 7 a.m. UK time, so we watch for that. 126 on the pound right now. Bitcoin giving up some of its gains. Maybe a bit of rally fatigue kicking in now for that cryptocurrency. 87,000, currently down 0.5%. And Brent taking another knock in the session, looking to end the week lower, falling 1% on concerns about a glut in oil inventory. 71.80 on Brent. Let's get to the comments from Jay Powell then, saying the recent performance of the US economy has been good, giving the Fed chair room to lower rates at a, and this is important, careful pace.
With labor market conditions in rough balance and inflation expectations well anchored, I expect inflation to continue to come down toward our 2% objective, albeit on a sometimes bumpy path. We're confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks to both sides. The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve.
Okay, for more reaction and context, let's bring in Bloomberg's Valerie Teitel, our markets reporter, in terms of how the markets adjusted. Is this then, Val, a slightly more hawkish Jay Powell? Is this a hawkish tilt from the Fed chair?
Tom, it certainly is. He very much solidly opened that door to a Fed pause as soon as December. He talked very openly about they're in no hurry. He even went on to say in the Q&A that going slower, if the data allows them to go slower, seems like a smart thing to do. Now, this is in the guise of a labor market holding up a little bit better than expected and inflation coming in a little bit higher than expected. He even noted that the inflation data recently points to a bigger bump than the Federal Reserve has expected. Let's flip on and talk about how 2-year yields traded, because we have completely reversed the post-CPI rally. We rallied on CPI, where that Fed cut in December was very much priced in. And then yesterday, we very much brought those doubts back again. We're now looking at a 50-50 chance of that December rate cut in just a few weeks' time. The equity market, if we flip on and take a look, is not really liking these more hawkish words from Powell. We have S&P futures, NASDAQ futures, and Eurostoxx futures all in the red after these hawkish words from Powell last night.
Okay, yeah, the betting and the trading and the pricing around that December decision from the Fed has been all over the shop this week, hasn't it? So down to 50% chance of a cut, just 50% chance by December. Look, the Fed officials have tried to kind of make the case that the incoming Trump administration isn't going to impact what they do, which is clearly going to be a fallacy at some point, isn't it? What are we hearing in terms of Fed's reaction to the potential policy reaction and the policy agenda of this incoming Trump administration? Did he address that finally?
He did. He got asked a few questions on this, Tom. One thing notable that he did talk about when it comes to the fiscal spending and the tax cuts that the Trump administration has to put through, he noted that it will take a year for such legislation to pass, and for that to have an effect on growth, we could be waiting until 2026 or 2027. So clearly they see a lag into a growth impulse from the pro-fiscal spending policies from the Trump administration. He also talked about tariffs, saying it's not obvious their effect on growth. But, Tom, his focus was squarely on growth, not on an inflation impulse from these tariffs. Lastly, on immigration, he spoke in saying that a shrinking of the labor market from perhaps a deportation of migrants would be negative on growth, because we've seen the opposite in just the last few years. In 2023 and 2024, he commented that the labor market had more people in it because of positive immigration, and that could be undone if Trump does go ahead and have a more hawkish immigration policy and deport migrants. But very interesting to see Fed Powell weighing in on these things, Tom. His first three questions, though, were on Federal Reserve independence, where he squarely said that the Federal Reserve acts in the interest of the people, not in one specific party.
OK, Bloomberg's Valerie Teitel will continue, of course, to pass the comments from Fed officials in response to what they expect from this incoming Trump administration, of course. Thank you for the context. And again, a big day once again for how the markets are pricing in expectations around the next moves for this Federal Reserve. Now, in a controversial pick, to say the least, the US president-elect has tapped Robert F. Kennedy Jr., a prominent vaccine skeptic. Yes, Vaccine-Skeptic, to run the Department of Health and Human Services. Let's bring in Bloomberg's opening trade anchor, Kriti Gupta, now. On some levels, good morning, Kriti, this is not surprising given the proximity of Trump to JFK after JFK stopped his own presidential campaign. We knew there was going to be something in the offing. How dangerous is this, though, potentially for the health of Americans?
This could be very dangerous in some of the ideas that RFK Jr. has specifically put out when it comes to things like, of course, vaccines. He is, as you put it, a vaccine skeptic, but also his recent comments on things like fluoride in drinking water. And just for our kind of international audience that may not be familiar with this, American water has an extra amount of fluoride in it. It's something that goes back to 1950 to kind of help, make sure it is healthy drinking water, it's clean, and also helps prevent some of the dental decay. It is, again, something that's been proven and endorsed by the government for almost 100 years when it comes to tackling some of the clean water issues in the United States. RFK Jr. has specifically talked about rolling some of those measures back. It's also crucial from a political standpoint that he is, of course, a part of the very celebrated political dynasty of the Kennedys, all of which who had come out and supported the bid for originally Joe Biden and then later Kamala Harris. And, of course, his uncle was the very celebrated JFK, and his own dad had ran, again, under the Democratic Party. So this is something that has not been endorsed by the family and is therefore a controversial pick in terms of U.S. politics, in addition to some of the ideas that he's pitching.
Yeah, you have to wonder on fluoride. We Brits get a lot of stick for our quote-unquote bad teeth, don't we? 4 years down the line, let's see if the tables are turned, if he really pushes through with that and see the health and dentistry health or dental health of Americans, if that goes through. Meanwhile, switching focus, Jamie Dimon not being picked. Not a huge surprise there, but of course a major figure within the world of finance and often speculated to have some role, at least be eyeing some role in politics. Not going to be picked for the new administration after previously saying he may consider, Trump is not considering him, saying he may consider JP Morgan CEO for Treasury Secretary. He's now said he's not going to do that. Dimon responded, interestingly, while speaking to us at the APEC CEO Summit in Peru. Take a listen.
First of all, I wish the president well, and thank you. That's a very nice note. But I just want to tell the president also, I haven't had a boss for 25 years. And I'm not about ready to start.
Great response there from Jamie Dimon. What do we make of this?
Well, we, of course, know that Jamie Dimon has been very, very quiet, very neutral on the sidelines of this campaign. But his wife, Judy, has been reported by the New York Times to be knocking doors for Harris on the campaign trail. So, again, there was some question about that. He did actually, in that interview, also talk about the fact that a Trump administration could deregulate Wall Street, and that could also be a positive broadly as well. Donald Trump, of course, responding and having this, you can see it on your quote on the board there in this quote, saying that he, of course, respects Jamie Dimon greatly, but will not be invited to be a part of the Trump administration administration, as he put out, but kind of celebrates him for his outstanding service to our country. Of course, whoever the new Treasury Secretary is will be working very closely with Jamie Dimon and some of the other CEOs of Wall Street, so we'll see how that all pans out.
Yeah, that's the big one we're still watching for. Opening trade anchor Kriti Gupta, thank you very much indeed, as ever. Now to China, where the economy is showing signs of stabilisation. At least it did in October, buoyed by better than expected retail sales. Let's get more then from our China correspondent, Min Lo. Min, break down the data for us.
Yeah, it's quite a mixed picture that we're seeing in the October activity data. And of course, the big standout is retail sales, a big beat there of 1% above estimates, coming in at 4.8%. Industrial production, though, slightly missing estimates, coming at a 5.3%. Estimate was 5.6%. Fixed asset investment as well, slightly below estimate, and I think property investment also extending declines from the previous month. And I really want to focus on the retail sales number here, because remember in October we have the Golden Week holiday where 750 million domestic trips were made, and you also have the longest ever Double 11 promotion period on record, at least a week longer than the previous year. You got a big boost to home appliance and electronic sales because of the government's equipment upgrading program. So the question here is really, does this signal an improvement in consumption sentiment, or is it a one-off boost because of that promotional period? Industrial production, missing estimates there, although Bank of America is saying they consider anything above 5% as pretty strong, pretty resilient there. And add to that, we have the PMI number going into above 50% for the first time in many months. So perhaps a very fragile recovery that we are seeing there. That could possibly also be derailed by Trump's policy. So that's something to continue to monitor over the next couple of months. But I think property investment, that was something that was a bit of a disappointment to me, because we had that series of measures that were introduced over the past couple of months, including the lowering of down payment ratios, easing home buying curbs and so on. But that really hasn't showed up in the data. And even though we got preliminary data from the top 100 developers showing that home sales did flip from negative territory to positive territory for the first time in about 16 months, but that doesn't really tally with official data showing home sales still down by 22%. So quite a dichotomy there, which suggests that maybe this recovery is very lopsided, perhaps supporting some of the state developers more than others. And of course, home prices down 0.5%. A slower pace of decline compared to the previous month of 0.7%, but still very far from positive territory. And people are not going to buy homes if they believe that the home prices are continuing to fall.
Yeah, indeed. OK, important wrap of what looks like a mixed picture when it comes to China's data, with the positivity come through for retail sales, but maybe question marks still over the property sector. Bloomberg's Min Lo joining us out of Hong Kong. Thank you very much indeed. To the UK now, where Bank of England Governor Andrew Bailey has used his Mansion House address last night to warn against raising tariffs in response to US-led protectionism, advocating for free trade and openness. This, of course, amid fears that President-elect Donald Trump will kick off a global trade war when he enters the White House.
The picture is now clouded by the impact of geopolitical shocks and broader fragmentation in the world economy. Now, I have to own up to being an old-fashioned free trader at heart. I think it's a British characteristic. I like to think it is. My point is this: amidst the important need to be alert to the threats to economic security, let's please remember the importance of openness. It's an important determinant of productivity.
OK, BOE Governor Andrew Bailey, of course, talking about the need for open trade. Let's bring in this point Bloomberg's Leo Kirchapper for a take as well on what we heard from Rachel Reeves, the Chancellor, of course, and her message to the importance of the financial sector here in the City of London. Leo, what were your key takeaways from the Chancellor's messaging to the financial sector?
Yes, good morning. I think for me the key message was the Chancellor saying the crackdown on UK banks after the financial crisis has gone too far. And this has, of course, been part of the debate, part of the sentiment here in the city over the past couple of years. And obviously you have the government now nearing its exit from the former Royal Bank of Scotland, NatWest. And you also have the bonus cap being abandoned. And now the the announcement, the key takeaway yesterday was the Chancellor saying she plans to tweak the senior managers and certification regime, which basically held executives to account for misconduct that happens under their watch. She wants to tweak those rules to make them less costly for financial services firms. I think that was quite a key announcement, actually. She also wants to modernize the so-called FOSS, the Financial Ombudsman. It doesn't sound too exciting, but it's actually the FOSS played a key role ahead of the motor finance investigation by the FCA, which is dragging down banks' shares and has even US investors concerned. So another key announcement there. And she also said the government might publish a competitive strategy as early as next year, and that might lead to a broader shake-up, actually, of regulators. So definitely something to watch here.
OK, Leo, thank you very much indeed on some of the language, the sentiment at least being pushed by Chancellor Rachel Reeves, some of the changes that may be in the offing. Again, an important time, of course, when we look at that auto financing story that seems to be expanding in terms of its potential scope and impact on UK banks. Bloomberg's Leo Kenshoper, thank you very much indeed. Coming up, US stocks taking a breather, at least for now, after a Donald Trump rally, of course. But what's next for the S&P and what risks lie ahead? We're going to get the view from Stephanie Gilt, Head of Investment Strategy at Robinhood Financial. Plus, Aegon announces a new €150 million share buyback programme. We're going to speak with the CEO of the Dutch life insurance company later in the programme. This is Bloomberg. Welcome back. US stocks have surged, of course, since Donald Trump's victory, with the S&P 500 briefly topping 6,000. Our next guest says she thinks there's a 20% chance of it hitting between 6,000 and 6,100. That was her previous target. Of course, by the end of the year, we are now in that territory. Very pleased to say I'm joined by Stephanie Gilt, Head of Investment Strategy at Robinhood Financial. Stephanie, thanks for joining us in the studio. So the bull market in US stocks is there. It's taken a bit of a breather in the last few days. The next steps for this S&P 500, do you upgrade your targets as you push into 2025?
Yeah, I mean, we're knocking on the door of what I thought there was a 20% chance of hitting. And I always thought, like, the election could be the thing that sort of pushes it higher, depending on what the outcomes were. I do think we could get to around 6,300 in the next 3 to 6 months. But that being said, I actually am a bit more positive on the mid-cap space, for example.
What takes you to mid-caps? What are the catalysts that are going to keep the moves into mid-caps? And why are you not yet seeing enough evidence to kind of want to push further into small caps?
I think it's a couple of things. One is that the mid caps in general tend to have, or at least right now, have a better valuation than large caps, but are a little higher quality than small caps. And small caps, I had a call on it actually back in June, and it's rallied quite a bit, especially post-election. And if I think about some of the other policies that may be coming, they could be inflationary. And that's not necessarily a good thing for small caps, and especially valuations in small caps. Small caps tend to have about 20% more leverage on average than large cap names. Mm-hmm. And if you're in a higher for longer interest rate environment, or that's maybe a little more guaranteed, then that doesn't necessarily bode well for a higher, more leverage on a balance sheet. So
mid-caps could be the sweet spot at this point. Yeah. Does the bond market sell-off derail that thesis? What level of yields would be a challenge, I guess?
Yeah, I think for the whole market, the level of yields, if we start moving materially above 5%, like maybe 5.5% or higher, which is possible, if the bond vigilantes come out.
OK, and you have concerns about the deficit next year, some of that tied to the incoming Trump administration's potential policies. Is 2025 the year of the bond vigilante then, or can they absorb all this issuance?
It's possible. If you look back in history, the last time the bond vigilantes were out, it was when deficit was 3% of GDP or higher. It sort of averaged that in the 80s. That's where we actually are as of the end of this year. And I know the deficit has been a growing issue, especially in a post-COVID world, but we're at $1.8 trillion, and it's very hard to see where we can make those cuts. And some of the policies that are being talked about, like tariffs, if you look at the last time tariffs were put into place, I looked at how much we made in 2023 from tariffs. It was $80 billion. It's very small compared to a $1.8 trillion deficit. And so I do think there has to be some real, a hard look at our own budgets to really think about the long-term future.
And it doesn't seem like either party is going to be taking that issue seriously, at least for now. So maybe the bond vigilantes will have to force the issue. How does Europe fit into your portfolio at this point?
I have had some. We did like some of the larger cap tech names that are in Europe. But generally speaking, we have been staying away from it because we generally look at for U.S. investors, and the dollar has just been so strong that it's been hard to be super positive on Europe. And just briefly, before we let you go, where are you finding margin at this point? Margin resilience? Yeah, there's been margin resilience in the tech space and in, well, actually, that's not true. What I was going to say is that we haven't actually seen a lot of margin resilience, and that's actually why we are in this, I think, the fourth soft landing since 1960, because if margin compression is allowed, then you actually have a lot of research and development, and that actually fuels long-term growth. So no matter what happens with policies, that's actually a place, like you've seen CapEx has grown at a greater amount than sales growth for the last couple of years in the S&P. Stephanie, thank you very much indeed for joining us bright and early around the set this Friday. Stephanie Guild, Head of Investment Strategy at Robinhood Financial, with a call there on mid-caps in the US, but a cautionary note around the potential tick-up in yields stateside, of course, as we look into 2025. Coming up with 1 week down when it comes to the COP29 summit and 1 week left, we're going to look at how much progress is actually being made, if any, at the climate conference. That's next. This is Bloomberg. Welcome back. Now, this year's COP29 summit in Azerbaijan has been overshadowed by Donald Trump's re-election in the US. Here with more about what to expect from the negotiations in that petro-state is Rodrigo Quintero, an associate in Bloomberg NEF's energy economics team, so very well placed to give us the context. Has there been any achievement whatsoever in the last week at COP29? Anything of significance?
Yeah, our expectations are published on a scorecard where we kind of rate different categories. How successful do we think each meeting can be? And we do this for different COPs. This year, we have 9 different areas that we think are key if we were to align with the Paris Agreement. And where we actually see some progress can be done is defining some targets for power grids, for energy storage, and probably creating a carbon market where nations can trade carbon credits. But of course, we need to consider the context in which the summit is taking place. So we have European countries and other developed economies which have concerns because they have constrained budgets. And also we have the US, of course, with the change in administration next year, that brings different risks. For instance, next year, the US might leave the climate stage, as they did during Trump's first period, and also influencing other nations. 2 days ago, we saw Argentina representatives leaving COP. So this is the kind of things that we're looking at now.
Just briefly, climate finance, always a thorny subject. Where do things stand on that front?
Climate finance is a hot topic this year, and the idea behind it is about nations that were responsible for polluting in the past will support those nations less responsible. So these have led to pointing fingers on who are the responsibles to bring this finance in. And if we look back, emissions have been coming most from developed economies. If we look at China, if we look, at the US, at the UK, or countries from the European Union, they are responsible for 58% of emissions since the 1850. But also, if we look at China or India, they have increased in the last 5 decades substantially those emissions, bringing the question of who actually needs to finance emerging economies.
Rodrigo, excellent context. Really appreciate it. Thank you very much indeed. Rodrigo Quintero, associate in Bloomberg NEF's energy economics team. Really smart analysis from that team throughout COP29. Coming up, European leaders girding, of course, yes again, for the impact of Donald Trump's trade tariffs on their economies. We're going to discuss that next. The potential economic hit. This is Bloomberg. Good morning, happy Friday. This is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. Traders trim bets on a Fed cut next month. After Jay Powell says there is no hurry to lower rates, with the US economy in, quote, remarkably good shape. President-elect Donald Trump picks vaccine-skeptic Robert F. Kennedy Jr. to lead the health department. But there's no room for JP Morgan CEO Jamie Dimon. Plus, Asian equities gain with signs that China's stimulus efforts are bearing fruit. Retail sales growing at the strongest pace in 8 months. None of that, though, doing much to boost the fortunes of European futures, which are pointing lower by around 0.7% as things stand. Yes, you're braced for losses after gains of more than 1% for European stocks yesterday. You are set for a third straight week of losses across the European equity space. FTSE 100 futures down by 36 points, off by 0.4%, and the sell-off in oil may be pressuring the picture for the FTSE 100 and the oil majors listed there. S&P futures pointing lower by 34 points after a drop of around 0.6% yesterday. NASDAQ 100 futures now falling 168 points, pointing lower by 0.8%. Let's flip the board and look cross-asset then. You saw 2-year yields spiking about 8 basis points yesterday on the back of those comments from Jay Powell at one point at least. You're getting 4.34 right now on the US 2-year yield. Markets pricing in just 2 additional cuts from this Fed by June of next year. December is a 50-50 toss-up at this point, according to market expectations. The pound in focus as we wait for GDP data out at 7 a.m. UK time, 126 on sterling. Bitcoin taking a bit of a breather in terms of the run-up, maybe looking for a little bit more detail in terms of what the Trump administration might do to support the crypto space. 87,974 right now, down 0.3%. And Brent taking a hit, as I said, down 1%. You're set for another week of losses for oil on concerns about a glut in that market. Now, to the macroeconomic picture with a focus on Europe and the impacts of potential tariffs, of course, coming from the US. New forecasts from Germany say the economy will grow by just 0.4% in the next year due to underlying problems and cyclical weakness. This as Bundesbank President Joachim Nagel says Donald Trump's threatened tariffs could derail Germany's recovery. I didn't even know Germany was looking at a recovery. Let's discuss this and the wider European outlook with Melanie Debono, Senior Europe Economist at Pantheon Macroeconomics. So we have that warning. Good morning. Thanks for joining us. We have that warning from the Bundesbank President around a potential 1% hit to GDP out of Germany on tariffs out of the US. We as yet to know what those tariffs will look like, but a 10% tariff from the US on European imports into that market. What impact would that have? What is your modelling suggesting about the potential economic hit of Trump tariffs?
Trump tariffs would raise prices for European goods for US consumers. So the likelihood is that export volumes will go down. So countries like Germany, who export quite a lot to the US, and in fact the US is the most important trade partner for the Eurozone as a whole, will see a hit to their export markets. Also, it will probably affect business sentiment across the board.
OK, so the business sentiment impact will be there. What is the response then from Europe? Does the responsibility fall inevitably to the ECB, or will there be some fiscal response from Europe to shore up this economy?
It is likely that the Trump administration pushing ahead with tariffs will bring in some response from the European Union as a whole. It could be that the European Union retaliates and raises its own tariffs, for example. But it's likely that there will be a fiscal response from most European economies because undeniably Donald Trump will go and reassert the need for European countries to raise their defense spending. And also, if countries like Germany want to remain competitive in their industry, which at the moment we know German industry is quite in a rut, then it's likely that they will have to spend more on trying to boost that industry. So fiscal spending is going to go up from the European Union.
Fiscal spending will go up. Let's take a listen to Mohammed El Erin, formerly, of course, of PIMCO, now a Bloomberg opinion columnist. Let's take a listen to what he had to say about the challenges of Europe. Let's take a listen.
If you look at the good, the bad, and the ugly of the global economy, unfortunately, Europe is in the ugly. Cyclically, they're challenged. Secularly, they're challenged. There is no definitive political leadership in the two countries where you need it most, Germany and France.
OK, Europe is in the ugly. He has a point, doesn't he? When it comes to the elections in Germany next year, do you get a less ugly German government response in terms of the challenges of that economy?
At this point, the way the polls are going, it looks likely that a grand coalition between the SPD and the CDU or CSU parties is the most likely outcome from the election in next February, on February 23rd. And because the government is unlikely to include the FDP and Christian Lindner, who we know was the reason why the coalition has fallen off the rails, the previous coalition, it does look like there is an open door to more fiscal support in Germany. So assuming that the CDU and the CSU come on board to spend more, which we think that they will do because of the likelihood that the US election will need a boost for that, and because they want to get more votes, more fiscal spending gets you more votes, then yes, the response will likely be more favorable towards more fiscal spending after the
Okay,
election.
so more fiscal spending is your message, seems to be coming through as the politics in Europe adjusts.
Yes.
Is that accompanied by greater monetary policy easing from the ECB? The markets are pricing in about 140 basis points of cuts between now and October of next year. Does the ECB go that far? Do they need to go further and faster to support this economy?
We do not think that they will go as far as markets suggest. So we think that because inflation undershot in September, then the ECB is likely to push down its forecast come December, and this downgrade will likely push them to cut rates by 25 basis points again this year, taking the deposit rate to 3% by year end. But then we only look for 2 more cuts next year. And the reason for that is that we expect inflation to be biased towards or above the ECB's 2% target, especially in the coming months and quarters towards 2026 particularly. And that will mean that they'll go cautiously and will probably hold back. We also think the neutral rate is probably higher than markets expect.
Okay, so the neutral rate, and that debate is very live, isn't it? Both on this side of the Atlantic and over in the US. Is the Fed, is a slightly less dovish Fed, is that a constraint on how far the ECB can go?
The ECB will be unfazed by lower probability or lower rate cuts from across the Atlantic. The President Christine Lagarde has made this clear in the past. She has said that the ECB is data dependent and not Fed dependent, particularly.
And you believe that?
We do, yes. The way the data are coming in, it's unlikely that, because we already expected less cuts than markets, it's probably likely that what has happened in the past and across the Atlantic probably supports that view even more so.
Okay, I wonder if you have a view on the euro then. 105 right now. There's a view from some that you get to parity with the dollar in the near term. Given that you expect a relatively more constrained ECB, certainly more constrained than the markets are suggesting, but with that fiscal impulse, where do you see euro dollar next year?
So we see the euro dollar currently ending the year around its current level, because the way it's fallen so far means that markets are pricing in the likelihood that the Trump administration will push through with higher tariffs next year.
You think tariffs is priced into euro right now?
I think so already, yes. A small amount of tariffs, so probably 10 to 20%, nothing more major at this point. But then once tariffs do hit, we think that there will be more pressure on the euro, so it will probably go down maybe to 102 by the first quarter.
Close to parity is where euro gets if and when those tariffs come from the Trump administration. Really, really interesting context in terms of this European economy. Expectations of more fiscal stimulus, but maybe the ECB not going as far as the markets are expecting. That's the view from Melanie Debono. Thank you very much for joining us in the studio this Friday. Senior Europe economist at Pantheon Macroeconomics. Now, from German politics and the broader Eurozone to what's happening in France. France's Prime Minister says he may have to trigger a clause in the Constitution and bypass a vote in Parliament to get the budget approved. Michel Barnier made the comments in a newspaper interview. Lawmakers rejected the budget on Tuesday, sending the debate on reducing France's ballooning deficit to the Senate. JP Morgan CEO Jamie Dimon says companies will be more aggressive in pursuing acquisitions after Donald Trump's victory. He spoke to Bloomberg at the APEC CEO Summit about how regulations have previously stifled deal activity.
Because they have the Senate, the House, and the presidency, they have far more ability to do things like that. I think last time around, President Trump had started by saying for every new regulation, 1 in, 2 out. And I think later I said 1 in, 5 out. I think they're going to do some of that again. I think it will, the banking industry, whether you voted for Trump or Joe Biden, a lot of bankers, they're like dancing in the street because, they've had successive years and years of regulations, a lot of which stymied credit, and so and you could have kept the banks equally safe, but had them do more credit. And so to just give an example, the average bank in America, I think the number used to have $100 of deposits and $100 of loans, and now it's $100 of deposits and $65 of loans. And if that's what you want, if for some reason the regulators think they're geniuses and that's the best way to run the banking system, so be it. But I think they did a lot of things that ended in that answer, but they didn't know that was going to be the outcome. So, and I think you could talk to any industry, and they'll give you examples of regulation that could be reduced and make it easier for them to do business while keeping the country safe, while keeping the air clean, while making sure the EPA does its job, et cetera. So I applaud them. They should be looking at those things.
Do you think if there is, particularly in the banking sector, less regulation, that there will be an even steeper competition with banks getting back some of the business from private investment firms?
Probably, yeah. I mean, because if you look at, you're asking about private credit and private investment, which I'm not against, and it has grown very rapidly, and it's got pros and cons. I'm always in favor of competition, but part of the reason that they are dancing in the street, which they said publicly, they used to get mad at me, now they say, no, he's right, is half the capital. No social requirements, no AML, no BSA, no fiduciary, no reporting to the government, no insurance, no liquidity. Yeah, it's a huge disadvantage. So yeah, I think it'll make banks get back some of that business. I think it'll be more important to regional banks than to JP Morgan.
There's also a question, whether it's banking mergers and acquisitions or just more broadly, whether there's going to be a more amenable administration to tie-ups. Are you seeing from your conversations in the past 7 days with companies that they are looking to expand their M&A pipeline to start putting that together? Yeah, so absolutely. I mean, a lot of M&A was stymied by the fact it's not just sometimes you can't get through the courts or something like that, but it takes 2 years. It takes 3 years. So make believe you're a bank, and we've seen this happen, and one of these deals actually took 3 years. It takes 3 years to get it done. So you've done a deal, it's binding, you haven't closed it, but now you've got to run the company. You can't get the synergies, you're going to be losing people. You want to start working a common culture and common technology, you can't do it. So yeah, a lot of companies are looking at, will be looking much more aggressively at acquisitions and deployment of capital, and they should.
Okay, JP Morgan CEO, of course, Jamie Dimon, speaking with Bloomberg's Lisa Abramovich at the APEC CEO Summit. Coming up, we're going to speak with the CEO of Aegon on the Dutch life insurance company's latest earnings as they announce a new €150 million share buyback program. This is Bloomberg. Welcome back. Now, Aegon has announced a new €150 million buyback. This is the Dutch pensions and insurance company reported lower adjusted operating capital generation for the third quarter. Aegon CEO Lard Friese joins me now. Lard, thanks for joining me. Talk to us about the buyback plans and €150 million. What does it signal about the outlook for the business? Is there more that you can do to return more cash to shareholders?
Good morning, Tom, and thanks for having me. What it signals is capital strength, to be short. If I look at the update that we're providing to the market today, we're coming in with an operating capital generation of €336 million, which is strong. And as a result, we've upgraded our guidance for the full year to €1.2 billion of operating capital generation. We've also, been transforming the company over the last years. And as a result, the business is operating much better. There's profitable growth. We're managing the capital on closed blocks of business very tightly. And as a result, our ability to generate capital has increased quite a bit. We've also put together our Dutch business with another listed company last year, ASR. And then we started a buyback program of roughly €1.5 billion, which we have completed in the course of this year. But because the company had a lot of capital strength coming through, we launched on top of that earlier already a $200 million buyback, and now today another $150 million. And that's all proof testament to the fact that we are able to profitably grow the business.
So investors can potentially expect more in terms of returns to shareholders as that capital increases.
Well, we aim to grow, right? We aim to grow profitably. So if we can use the cash capital that we are creating, and we can use that for accelerating our growth profile at good returns in the business, or if we can find value-creating opportunities, we will certainly look into that as well. But if we have cash in excess of what we need, we regularly review that, and we cannot invest it at good returns in the business or in other value-creating opportunities, then we have a clear strategy to bring it back to stockholders over time.
What's the outlook for the business looking like as you look into 2025? Which parts of the business do you think are going to be outperforming?
Well, we've seen continued strength with, for instance, the asset management business on third-party flows. We've seen that now for 4 quarters in a row, and this quarter was no exception. We're growing our sales force in the U.S. quite substantially, with 19% year-on-year to 82,000 agents. And on the back of that, we aim to grow the volume of our business in the U.S. Our retirement business in the U.K. is doing very well, showing a lot of strength, and is now the one in the top 3 of winning new business in retirement, which is doing well. And we also believe that after some weaker periods, that our Brazilian business can continue to grow, and that also the business in the other markets in our international businesses in Spain and Portugal and also China to continue to grow as well. So we believe that we have a number of areas and product lines where we believe we're well positioned to continue profitable growth path.
Okay.
Well, in other product lines that we have closed for new business, we aim to risk manage it well.
Okay. In the first half of the year, you recorded that charge, a slightly higher than expected charge, on a pickup of mortality, essentially, and quite frankly, more people dying after COVID. Are you still seeing elevated mortality as a consequence of COVID? Does that continue?
We have adjusted our assumptions indeed at the second half of the year because we noticed that especially in older age cohorts, post-COVID, unfortunately, we saw more death claims coming through. Since we have adjusted it, we had to take a charge, but we also gave immediate guidance that we expected the operating result to increase moving forward from that charge that we took. And indeed, it's one of the elements that you can see back in our operating capital generation, which this quarter came in quite strong.
How do you expect the Trump administration to impact your business? Is that a positive for you in the business in the US or a challenge?
As we do what? Investing the capital back into the business? That's actually
I was asking
that we really love to
what
do.
You think,
because
what you think about the impact of Lard, I wanted to know what you thought about the impact of a Trump administration on that important US business for you. Will that be a catalyst for more growth or a challenge for the business?
I think, frankly, it's too early to tell. I mean, we're a week after the election results. The President Trump has not been inaugurated yet. He's now constituting his administration and having his nominees ready. So it's really too early to tell. But in the U.S., we have a business, Transamerica, which has been around there since 1909. We've worked with Democratic administrations, Republican administrations. So we aim to work very constructively also with the Trump administration. But too early to tell.
OK. From the US to the UK, we heard from the Chancellor here, Rachel Reeves, speaking yesterday about maybe regulators being a little bit overburdening the financial sector here. I want to take a listen to Rachel Reeves and then get your response. Just listen in.
It was right that successive governments made regulatory changes after the global financial crisis to ensure that regulation kept pace with the global economy of the time. But it is important that we learn the lessons of the past. These changes have resulted in a system which sought to eliminate risk-taking. That has gone too far. And in places, it has had unintended consequences that we must now address.
Lard, do you expect to have a more friendly regulatory regime here in the UK? And do you welcome the changes around mega funds and pensions here?
So first of all, I agree with the Chancellor that it's very important that we remain very balanced with effective and good regulation that keeps the system safe and that operates in the interest of our of clients. I think regulators and the industry are aligned there. I do also agree with her that some of these regulations have gone too far and have, as a result, not fully utilized the full strength that the industry can bring to, for instance, long-term savings and allowing customers to do proper long-term savings, being able to spread their investment risk in all kinds of investment portfolios. And therefore, I agree with the Chancellor. She also said yesterday evening that there is she launched the British Growth Partnership, and Aegon has announced that we are going to be a cornerstone investor in that effort.
OK, Lard, thank you very much indeed for your time today on the back of those earnings and the announcement of a €150 billion buyback for the business. Lard Friese, Aegon CEO. There's plenty more coming up. Stay with us. This is Bloomberg.
We could probably trade 6,100 probably before year end. So we're right there. Could we get higher than that in the near term? I think it's going to be hard. But yeah, we're marching higher. Finally, after 2 years, we're finally starting to see a broadening out in the broader economy. And that translates into better stock performance for the average stocks.
Morgan Stanley Chief US Equity Strategist Mike Wilson talking about the strength of the US economy, and that was something that was reiterated by Jay Powell yesterday, and he drew a line under that, and that for some in the markets was a bit of a hawkish tilt. We were at 80% chance of a December cut yesterday before those comments. Now we're at a toss-up, about 50% chance, and this is how the markets and those trading bets have adjusted, as we've heard from those Fed officials. No rush on the need to cut further. In fact, markets are pricing in just 2 additional cuts from this Federal Reserve between now and June, and not seeing sub 4% on the rate until about September of next year. Let's flip the board and have a look at what's happening in terms of the preview of US retail sales, because, of course, the strength of the US consumer has been there, and that will be a factor in how the Fed decides about its next steps. So we have retail sales out later today. Expected, the Economist estimates are that you'll see a little bit of a cooling to 0.3%. Bloomberg Economics says, look, it's still going to be a pretty decent number, and they expect particularly car sales, discounts as well, to drive and continue to put strength under the retail sales print. So that data dropping 1:30 p.m. UK time, and we'll see if that moves the needle on pricing around the Fed. Be sure to catch up, by the way, on Bloomberg's new weekend edition. We're going to be a collection of ideas, essays, reviews, interviews and stories that explore the fascinating places where finance, life and culture meet. My goodness. The opening trade is up next. This is Bloomberg.